Instead of paying minimum payments like the banks want you to, what if you could take those minimum payments and actually pay off your loan much faster? And we're talking about $30,000, $50,000, doesn't matter what the loan amount is. We need to make sure we are paying according to our plan versus the bank's plan. And I'm going to show you how to pay off your debt much faster than you ever had before by taking advantage of the minimum payment trick we're going to go over in this video. So let's dive in. First of all, I wanted to share with you a story that I know I've shared before, but I really want you to get this because I was going over with a client one of their credit cards, and it was a heartbreaking story. Okay, she had a $3,000 balance on her credit card, and she had a pretty good $50 a month minimum payment that she had to make. Okay, the thing about it was, $45 was going towards the bank, right? That means towards interest, while only $5 was going towards where? The principal. And she didn't know how the credit card companies made money off of her, okay? Remember, the credit card companies make money off of us in three ways. And those ways are the minimum monthly payment, the statement and the due date, and of course, the interest rate. Now, I don't remember how high the interest rate was there, but that's why $45 was going towards the interest rate. Now, you would be surprised as to how much the amount you pay and the frequency you pay makes a big difference on shrinking this number dramatically. And I want to show you by the numbers right now. Now, for those of us who don't really know how loans work, this is how loans work. Now, it doesn't matter if it's a mortgage, if it's a car loan, if it's a student loan, any loan, the bank is going to have to charge you, right? That's the cost of borrowing money. They're going to have to charge you interest. Okay, the cost of borrowing money. And when you're talking about a mortgage, right, at $200,000 at 6%, you're going to pay that $1,200 a month. Listen, that $1,200 a month does not go to the principal. Only a portion does. Now, some people think, man, that $1,200 is going towards the principal. Not necessarily the case. This is how it's getting divided up. $1,000 on the first month goes towards interest. $200 goes towards the principal, okay? That is where your minimum monthly payment is getting divided up. And now you may be saying, man, I feel like that one lady who only a little bit was going towards the principal. Yes, but we're going to change that, okay? So we want you to recognize that you've got to make sure that you repeat this. Please comment down below. The interest rate does not matter, okay? So we're going to go ahead and erase this interest rate because I don't need you, and Velocity Banking doesn't need the interest rate. We don't care about the interest rate. What we care about is diminishing the principal as much as possible. Now, for those of you who are getting nervous about the numbers, perhaps you don't have a mortgage, $200,000, I want you to know that not even the numbers matter. What does matter is the principal. Remember, the principal is the principal thing. So now that you know how the $1,200 is getting divided up, I want you to look over here. Pretty different, huh? Never seen that before? I want you to know how your money, that $1,000, that $5,000, that $10,000, eliminate your principal very quickly by deploying these numbers in a concerted way, okay? Here's how it is done, all right? I actually made a mistake here, so I'm gonna go ahead and erase all these because $1,000, you can make a $6 difference. $5,000, you can make a $26 difference, and with $10,000, you can make a $51 difference. Now, you may be saying, CJ, what in the world are you talking about? Well, remember, as you're paying something on a monthly basis, you got to pay it monthly, right? Or else there's going to be problems. There's going to be challenges that you have to overcome, okay? It's not going to be just the loan. In the second month, if you just pay the $1,000 towards the $200,000, you're going to go down by $6. That means this $1,000 on the second month, instead of just going down by $1, right? By paying the $1,200 a month, you're going to go down by 6, which means you'll be paying $994. Now, if you say, you know what, I actually want to, with my unsecured line of credit, I can actually deploy $5,000. If you want to go ahead and deploy $5,000, then this is actually going to go down by $26, which means what? Which means it's going to $974. All right? So let's do this, right? If you have $10,000, especially if it's HELOC, especially if it's a line of credit, personal line of credit, business line of credit, you got $10,000, I want you to know that interest is going down $51. So what does that mean? That means that now you're talking about $900, right? And $49 will be going to interest on the second month. Now, why does that matter? Well, it matters because instead of $6 going to them, remember, 6 times 12 is what? 12 months in a year? $72, right? Instead of that $6 going towards the bank, that $6 is now coming towards you. Instead of the $26 going towards the bank, that $26 is going towards you. Instead of the $51 going towards the bank, $51 is now going towards you. It's now going towards paying this gargantuan sum off. Now, yes, you heard me correctly. It is a line of credit that you can use, but you don't have to. You can use your reserves. You can actually say, you know what, I've done the numbers and I actually want to get my IRA, my 401k. I want to make sure that I'm using the money, right, that I've worked so hard for. I want to make sure I'm using it correctly. These are the amounts, right, that you'd save and that is going towards the principal side. Now, I want you to know something. I know that there are people that have more than mortgages, right? Perhaps you have a car loan. And I want you to know that $37,000, let's just go ahead and say you have a car loan for $37,000, you got 9 years. I tell you what, let's just put the 9 years out there, all right? I've never seen a 9-year car loan, but let's just do that. What if they were that nice, right? $37,000. Which one would you pay off first? Well, let's let the numbers do the deciding. Let's let numbers do the recommending, okay? Now, do you remember what is called the cash flow indicator method? Okay, the cash flow indicator method is going to be, let's go ahead and put that right here, at 6%. Okay, you got $444 each and every month. Okay, remember that's not going towards the principal, only a portion is. But the cash flow indicator method, what that is you're going to make sure you're getting rid of the most cash flow sucking loans, which means you're going to do math. Let's put this $37,000 and divide that by the minimum monthly payment, and then let's do the same thing with the mortgage. All right, so you can tell that this loan is from fairyland or fantasy land because, man, it has a score, a cash flow indicator score of 83, and most car loans are actually cash flow sucking. And so, but in this example, right, as it would be in the real world, you would actually prioritize the car loan over paying off your mortgage, right? Because the mortgage is at the freedom zone, okay? It's 100 and above. You don't have to make that a priority as far as paying it off. Now, if that's your only loan and you want to, then absolutely you can do that, all right? But with the car loan, it's going to be the exact same thing, okay? You're actually going to, if you want to deploy that $1,000, you're going to be saving $6. Remember that $6 is going from the interest side to the principal side. If you want to deploy the $5,000 instantly, you're going to have that $26 that was going towards the bank. Now it's going towards the principal side on the car loan. And of course, the $10,000, that $51 will be going from the interest side to the principal side. Now, I know what you're saying. I know what you're thinking. You're thinking, CJ, line of credit? Why in the world would you do that? Well, look, you can't use your line of credit like normal people do. Okay, you've got to use your line of credit like velocity bankers do, all right? What we do is we go ahead and we take this $10,000, for example, and whatever is left over after all the expenses, after all of the debt payments are paid, that monthly payments are paid, we're gonna go ahead and have that cash flow right here. So let's say your cash flow was $2,000, all right? What is that? 10 divided by 2, we're getting out of that line of credit in about 5 months. And after 5 months, what can we do? Come on, whether you are deploying 10,000, whether you're deploying 5,000, 1,000, 500, 300, 200, or even $20. What are you going to do with it? You're going to deploy it again and again and again. Doesn't matter if it's the home loan, and it doesn't matter if it's the car loan. You're going to deploy it towards those principles with someone else's money. That's what I need you to understand. It's called unsecured line of credit for a reason. You did not put in on this. They looked at your credit score and they said, yeah, we're going to give them 20,000 in lines of credit, 10,000. Has anybody been a victim of a credit line increase? I know I have. All right, 5,000, 1,000, it doesn't matter. What does matter is how you are paying it. This is how you pay it, okay? 1,000 towards the principal. And we erased the interest rate because it does not matter when you're paying the correct way, all right? Remember, cash flow indicator, if you've got multiple loans, if you've got multiple credit cards and you don't know which one to pay off first, don't go by a financial advisor's word. Don't even go by my word. Always go by numbers. When you're making a decision, especially financially, numbers is what you make the decision by, not emotions. Listen, risk is a number. Did you know that? Okay, so the numbers is what you'll be calculating. Put it through your calculator. Whatever the loan balance is, whatever the minimum monthly payment is, you divide it and you'll get a number between 0 and I don't know. But if it's over 100, you're in the freedom zone. If it's between 51 to 99, you're in the caution zone, which means what? Which means, you can restructure it, you can refinance if that's what you want to do, right? You have some leeway there. But if it's between 0 to 50, that is the danger zone, and we need you to get rid of those loans as fast as possible. Do you know another method that is faster than the velocity banking way? All right. So listen, we love the debt snowball method. We love the debt avalanche method. We don't have a problem with any other methods. We run competition with no one. We collaborate with everyone as long as we can get this number down and capture this number. Because what is it all about, especially now? It's about capturing that cash flow that has been sucked away from us for too long. I want you to go ahead and take a picture of this. I want you to memorize it. I want you to do more than memorize it. I want you to internalize it so that you can pay off this and grab these minimum monthly payments. Guys, you've got to grab them. You're making these minimum monthly payments work for you. Does that make sense? Okay, so you're looking at the lines of credit. Okay, I know that there's a minimum monthly payment that is owed every time that you use your line of credit. But how much do you owe when you're paying your line of credit with your paycheck? Now you've captured that minimum monthly payment. Did you catch that? Now you've captured it. Now you're in control, which is what it's all about. Folks, if you have any question on the velocity banking method, on how to make your minimum monthly payment work for you instead of against you, go ahead and check out that video, and we'll see you in more videos. God bless and have a great night.